Good afternoon to all my subscribers and interested investors out there. This is Don Crone, and you are watching my channel called Live Long and Profit. The past month has been a rough one for the stock market, especially tech stocks. Now, we did have a bit of a bounce back today, but that certainly doesn't make up for all the ground that's been lost in the past month. Yields on Treasury securities have been rising in anticipation of accelerating inflation, which would be a result of the massive increase in the money supply from the stimulus package, along with the massive increase in consumption that is expected to occur as the economy reopens. The line I have heard repeated ad nauseum in the past month or so is that rising yields are bad for tech stocks. Everyone says it so casually, like it's a universally accepted adage. I have been searching for a clear explanation of the logic behind this adage, and I hadn't found one until now, until I read a recent column in Barron's on Friday night, which I consider to be the top publication for stock market analysis. This is what I saw. High rates hurt high growth stocks like Tesla more than others, for starters. Higher interest rates make it more expensive to finance growth. Secondly, high growth companies generate most of their cash flow far in the future. Higher rates make the promise of future cash a little less attractive, relatively speaking, than higher yields from bonds in the present day. So let's look at each of those statements. The first one is undoubtedly true. If interest rates are rising and you need to borrow a lot of money to keep your business going, it's going to cut into your bottom line. But then it becomes your responsibility as an investor to know whether a stock you own is highly leveraged or not. I disagree with the second statement, and that raised a question in my mind. I follow a lot of high growth companies, and my impression has always been that they are generating plenty of cash flow. So I decided to do a study of 10 of my favorite high growth companies to see what their debt and working capital numbers look like. Here is the spreadsheet that I produced. Now, the first thing you should notice is column C, which shows the 1-year return on the stocks that I've chosen as of the close on Friday, March 19th. Now, that's actually a good day to choose for a 1-year return, since the market was bottoming out around this time last year as a result of the initial shock to the economy caused by the shutdown. The first thought I have when I look at column C is that I wish I was prescient enough to have bought all these stocks last March 19th. The lowest return of any stock on the list that I studied was Lululemon, with a 99.35% return. The highest return would have come from Etsy at 521%. And I think it's important to remember that these numbers don't reflect the decline which all of these stocks have suffered in the past month, which is reflected in column D. These stocks, obviously, then all 10 of them have been a victim of the higher rates are tough on high valuations adage. So let's take a quick look at each of the stocks I have listed. Zoom, of course, has been the story stock of the past year. The closure of offices around the country has driven millions of people to use Zoom as the main means of communication for their jobs. This has resulted in a 163% return for Zoom in the past 12 months. Such growth has also resulted in Zoom's PE rising to 144, which is 3.6 times higher than the current 39 PE of the S&P 500. So, Zoom, out of all the stocks I chose, it fits nicely into the high valuation, high growth category. So how is Zoom doing in terms of debt and working capital? Now, the latest figures I could find were as of January 31st. Zoom's current ratio, which is defined as current assets divided by current liabilities, is 3.8. That's pretty impressive by itself, but their debt to equity ratio is 0.02, which means they have just $2 in debt for every $100 of equity that they have. Look at the working capital number. Zoom has $3.5 billion in working capital. So anyone who wants to make an argument that Zoom is financing its growth through debt just isn't paying attention or hasn't looked at the numbers. Now, I admit that there are special circumstances surrounding Zoom which would account for its recent drop. When the economy fully reopens, a sizable number of people will return to offices, so usage of Zoom will inevitably decline. However, wherever the number settles, it will certainly be higher than it was before the pandemic started. Plus, working from home is a trend that will not be disappearing as time goes on. There will definitely be fewer people going to offices 5 days a week than there were before the pandemic began. I am certain that the concern in the number of users dropping is why the street currently rates Zoom as a whole. If you take a look at the entire sheet, you will see that the automatic assumption that high growth companies are financing their growth through debt just is not true. Now, we do have a couple of exceptions on there. Etsy has, despite its 521% return in the past year, Etsy has $1.5 in debt for every dollar of equity, but they currently have $1.4 billion of working capital, so you can't call their current position perilous. DocuSign has $2.81 in debt for every dollar of equity and only $69 million in working capital, so you might be able to see that as a red flag. On the flip side, CrowdStrike has no debt, $678 million in working capital, and a current ratio of 2.37. So any notion that they are financing their growth through debt is just plainly ridiculous. Now, I realize that some of the companies on here are not profitable, and the ones that that are profitable have PEs that are well above the market. But that is the point of this whole presentation. To make a blanket statement and say that high growth companies have no cash flow and have a high use of debt is simply not true. That is why I think investors are unfairly punishing these stocks, probably along with institutional investors as well. And that once the talk surrounding inflation and higher yields, treasury yields subsides, you will see these stocks bounce back in a nice way. Do you agree or do you disagree? Leave a comment and let me know your opinion. Hit the subscribe button, of course, and ring the bell to be notified of further posts. I wish all of you a great day, safe, happy, and prosperous. Thank you.